Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We've got Bailey Lipschultz sitting in for Alex Steele. We're broadcasting live from the Bloomberg Interactive Broker Studio. We're doing the streaming thing on the intraweb, so I think it's youtube.com. You go over there and you search Bloomberg Podcast, and that's where you find us. Big news today for our good friends at Robinhood Markets. Stock's up 3.6% today. The company unveiling a credit card. I need more credit cards. Look at this stock here. See, I'm a Wall Street guy. All I care about is the stock. Stock's up 56% year to date. Wow. Trailing 12 months up 132%. It's got a $17.5 billion market cap. So big news coming out of our friends at Robinhood. Vlad Tenev joins us. He's the chief executive officer. He's a co-founder of Robinhood. He joins us here in our Bloomberg Interactive Broker Studio. I'm not on the Robinhood platform because I'm a gentleman. I need the Swiss bank secrecy laws protecting me. But my 28-year-old twins, who are the future of this thing, they are on Robinhood. They're very happy. They were psyched that I was talking to Vlad. Vlad, talk to us about your news today. You're not just a commission-free platform, which is in and of itself amazing, but you're now getting to the credit card business?
Yeah, we were really excited to announce this. We've been working on it for quite a while, and we didn't just want to launch another Me Too credit card. We really wanted to come in and do something special and really lead the industry. So it's really the best cashback rewards that we found in any credit card on the market, the best digital experience, and really the best design. We have a solid gold card that's basically a hunk of metal. It's extremely iconic, very simple, like very well designed. We're really proud of the product. Now, the hard work comes of rolling it out, but even since the announcement, in the first few hours after the announcement, which was last night, we had hundreds of thousands of people signing up for the credit card. So wow. It's looking very good so far.
How does the credit card fit into the business? Because I know early last year you guys announced a retirement product, so it feels like you're trying to expand away from the core trading platform?
Yeah, so as a business, holistically, we're focused on three things. The first is being the number one platform for active traders. Right now we're number two, but we have a path to being number one in some number of years. And that's really through user experience improvements, product innovations like 24-hour market, adding new asset classes like futures, new platform launches like our Web Pro platform, which we've announced. But we don't want to just be an active trader platform. We also want to grow wallet share with our customers and help them build wealth. And that's where Robinhood Gold comes in. That's where our innovations in the retirement program with the 3% match come in. And of course, now the credit card is sort of another pillar of us growing wallet share with customers and helping them do all of their financial activities in one place via Robinhood.
So are you competing with this card with the bank-issued Visa and MasterCards? Is that the market you're now going into?
I think that we're trying to do something really interesting with this card. So if you think about premium credit cards, yep, the best ones out there accept less than half of the people that apply.
Is that right? So
yeah,
it's like,
less than half of applicants.
Is that a Chase Sapphire or is that an Amex Platinum or whatever?
Those classes of credit cards, really like the typical sort of like super prime premium rewards cards, and they have high annual fees.
Right.
So what we wanted to do is, in the same way that Robinhood democratized stock trading, yep, and made it accessible to a wider group of people, we want to open up the private client experience. I don't know if you've been to a Chase branch, mm-hmm, but you can see there's two doors, one for the private clients, yep, and one for everyone else. And the whole idea behind Robinhood Gold is giving that private client experience for as little as $5 a month, opening it to everyone. And it starts with the premium credit card, of course, the retirement benefits where you get a 3% match, the first and biggest in the industry, the 5% APY on our cash, which is just a institutional grade high yield offering that you have to have, millions of dollars to match at other brokers. So yeah, we're putting all this together and we're seeing Robinhood Gold customers actually depositing the lion's share of their money into Robinhood and really growing with us. And I think we have an opportunity to offer them services for all of their financial needs.
And Vlad, the perks are pretty sweet. As you mentioned, 3% cash back on all purchases. Do you make money off of this? How is this going to be kind of another peg for the profitability and the growth of the company?
Yeah, two things there. One is we do, obviously, any business line we enter, we intend to be profitable over the long run on a standalone basis. So not just accretive, but we anticipate this being a profitable business line just within the card portfolio. And that's through not just the interchange transaction revenue, but also the lending business through the card. We anticipate this would actually be a very attractive card for people building credit over time and not just folks that pay off their balance in full. And then the other side of it is we see that when customers adopt Robinhood Gold, their rate of deposit growth and account balance growth is much higher than non-Gold customers. They also adopt our products at a much higher rate. And so even though they're getting so much more value with all of these industry-leading rates and value props, the revenue that accrues to the business from the Gold relationship is also multiples higher than non-Gold customers. And we think the credit card, since it's so core to people's financial needs, typically all of the lion's share of their spending goes through credit. And if you're using a credit card, much easier to grab the paycheck deposit.
Sweeney carries cash around, though. This is a guy who walks around with hundreds of dollars in his pocket. I don't know why.
I asked myself the same. When you walk into a bar, the Jersey Shore, you put good cash on the bar there. Vlad,
well, I'll show you what I've got in my pocket.
Oh, he brought the card.
That's very cool.
14 carats.
So let's show this. All right, folks, we're showing you this card. It weighs something. You got some heft.
Well,
there.
it is.
This is the card here, folks. It's awesome.
Basically gold bullion. Woo. It's not gold plated.
This is legit.
Solid
Vlad, I don't see
chunk.
your numbers though. I can't make some purchases right now.
That's the great thing about it, because this is a digital first card, and we outlined all of the awesome digital features like virtual cards, like family focused suite of features. Yeah, you don't actually need the number on it. You can open up the app, look at the number, the expiration date's on there. The design of the card is minimal, only the Robinhood brand, the chip, and on the back you have your name, and that's pretty much
Interesting.
it. So if it gets stolen or lost, you don't really have to worry about your actual number being used.
Yeah, but then you lost a cool card.
Replace it.
All right, so who is the typical Robinhood customer these days, client these days?
A typical Robinhood customer, I would say, is someone in their 30s.
Okay.
They tend to be an early adopter of technology. They have, half of our customers make over $100,000 in annual income. So it's not sort of like the paycheck to paycheck customer as maybe some people think.
Yep.
And we also have much larger customers with big accounts. We recently have been introducing matches. In fact, last night we rolled out another initiative, 1% unlimited deposit match into Robinhood for all dollars deposited for our Gold members. So basically, most financial firms charge you a percentage to keep your money there as a management fee. We're paying you a percentage to move your money with us. And these types of offers have really attracted people with much bigger accounts. We've had customers with tens of millions of dollars moving those accounts to Robinhood, and they've been very happy with the experience. So we have been adding capabilities to serve customers across the entire market, not just sort of in that middle tier, but also people with more money and people with less who are just getting started. We also would like to serve them and have been focusing on that demographic since day one.
And Vlad, when I talk to skeptics, they point out that you guys are heavily reliant on options trading, crypto volumes, and that driving the business. Paul mentioned the huge run up over the last 12 months. It's still down 48% from the IPO price. What is the kind of mission in the next coming months and years for the company to get back to that IPO price and trade higher?
Well, I think we've been doing really well focusing on the inputs of the business. I can't really control the stock price directly, but if we're growing revenues, if we're diversifying revenues, if we're launching innovative new products for our customers, I think we can kind of grow through market headwinds and high interest rate environment and be sort of like a company that thrives in all conditions. And you mentioned the revenues, and options trading and all of these things. But what's happened in the past couple of years is the revenue profile of the business has diversified as we've rolled out all these products. As of the last earnings report, several earnings calls, more than half of the revenue is actually net interest margin, not even transaction based. Right. So as we add more of these products, like the 5% yield on your cash, the profile of the business has also changed.
All right, Vlad, thank you so much for joining us. Really appreciate you coming into our Bloomberg Interactive Broker studio. Vlad Tenev, he's the Chief Executive Officer, co-founder of Robinhood. The news today, Robinhood unveils a credit card. And folks, it has some heft. This is a unique credit card. It's in a further push beyond the trading business there, and the stock performing very well there. We appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the issues here as we think about the ripple effects of what happened in Baltimore yesterday is who's going to pay for this stuff? And that kind of goes to the insurance discussion. And so when we have a insurance discussion, we turn to our expert, Matthew Palazola. He's the senior analyst, insurance analyst for Bloomberg Intelligence. He joins us live here in our Bloomberg Interactive Broker studio. So, Matthew, it's not every day that we have an event like we saw yesterday in Baltimore. From your perspective, from the insurance perspective, how do you think it's going to play out?
So we know a couple things. It's obviously still very early, but we've seen some stuff in the trade press, and there's a little more information than there actually normally is on some of these disasters. The bridge itself, I've seen reports that it's valued at about $1.2 billion. Okay. I have no idea how much it's going to actually cost to rebuild it. The ship, the Dolly that crashed, actually is carrying, in my view, an unusually large amount of insurance and reinsurance, which is a good thing in this case. There's about $3.1 billion worth of insurance and reinsurance tied to that vessel. Now, that's also separate from insurance that's on the bridge and kind of other things. The problem is it's going to take a long time to play out. So the reinsurance that's on there will probably end up paying the bulk of the claims.
And how does this compare to, say, a hurricane or another form of kind of natural disaster or thing that happens where you have insurance and reinsurers kind of all pointing fingers?
It's a more complex event, right? So on the back end, stuff we probably will never see, there'll probably be a lot more back and forth. In terms of the cost of the event, I'm assuming it's very early back of the envelope. It's probably a mid-single digit billions, probably like a 4 billion or probably even less, honestly, which is like a small hurricane. I mean, we have hurricanes that are 20, 30, 50 billion dollars. So in terms of the impact to the entire industry, it's probably very manageable.
Who insures this stuff? I mean, these ships go all over the world. They're monster ships. I have no idea how they get in and out of ports. Now that you think about it, they're so huge these days, and I got to traverse, dangerous waters, congested waters. Who insures this stuff?
So it's pretty interesting. The way it works is it's kind of a mutual claims paying group that it's specifically this ship, right? So a bunch of this is kind of the way insurance started. Honestly, is a bunch of people running the ships get together and they pool their resources, and that's where they get the insurance from. That's really only the very low layer of the insurance. So that's 100 million of the 3.1 billion of insurance, right? So then the rest of it goes to this global reinsurance market. Above the 100, there's kind of another bit of ship reinsurance, and then above that, it's the global reinsurance market. So think companies like Swiss Re, Munich Re, some of the Bermuda reinsurance companies. I don't know if they have specific exposure.
So do we know who's the names backing this? Who's insuring
We don't.
this?
We know that AXA XL was the lead on some of the reinsurance. We don't know by how much, and that was just reported by the group at the time when they renewed the policy.
If I'm a shipper and now my path is delayed and I have to rethink how I'm operating, is there anyone that I'm covered by insurance or reinsurance? Like, how does insurance play into some of the delays that are likely going to happen as they eventually clear the debris?
There'll certainly be some knock-on effects, right? So it would be a business interruption claim. So it's kind of, I think, pretty classic, meaning there's something in your way, you can't do your business, you'll have some sort of business interruption claim. It's probably on the primary insurance market. If you recall, in 2021, the Suez Canal got blocked by that ship. There was talk about like $10 billion worth of commerce a day going through there or something like that, and that was 6 days. Even when that happened, it wasn't a huge amount of business interruption claims for the industry, but that would be where it falls.
All right, so are rates going to go up here, or is this just a one-off black swan kind of event? Which kind of seems like it.
So reinsurance prices have been going up anyway, right? So, and the reinsurance market doesn't exactly move in lockstep anymore. It's kind of individual markets. So I think you will certainly see maritime reinsurance rates going up. So in case you're shipping anything overseas, Paul, you might have to pay a little more. But I think that's almost a given after an event like this, that just specifically to maritime reinsurance.
And looking at reinsurers, we've been sitting on the equities desk. We're trying to game out which stocks are going to move in which direction and who benefits and who loses. How does that play out? Like, is this in real time? We find out that X firm has to disclose that they're the main reinsurer on this, or how do those kind of dynamics play?
It's usually the way it works. So what will happen is, and I don't expect we'll see much of this for the names I cover, but what will happen is, as we go into earnings, if you are one of the companies with a big exposure to this and it's going to be material on your results, they will usually pre-announce that ahead of earnings, just so that they don't, dramatically miss the number on that day. So that will be the way it would play out in the market. But I don't think you're going to hear a ton from at least the Bermuda companies that I cover.
Gotcha. Where are we? I don't know, trailing 12 months on you're the disaster guy. So when there's a hurricane or some terrible fire with our friends in California or something like that, we turn to you. We haven't talked to you a lot recently.
Yeah, we've been all right. So even last year, what happened was Swiss Re just put out their annual catastrophe loss for the industry, right? And it was $100 billion for the third year in a row. And when I started in this industry many years ago, if you told me it would be $100 billion loss year, we'd be shocked, right? It would have blown off the chair. Now it's been 3 years in a row that's happened. The interesting thing about last year was a lot of it was caused by severe convective storms, so not huge catastrophes, not huge hurricanes. So it was kind of these smaller events that built up. So that's probably why you're not hearing these kind of headline things, but the losses, are still there. That said, the market's still very well capitalized, and it was still a pretty good year for the insurers, but that's kind of what's happening. And now if you get a big event on top of those accumulation of smaller events, then it could be pretty bad.
All right, Bailey's in the market for a beachfront mansion down in the Palm Beach area. Can you get insurance on that stuff sitting on the water?
It depends on the state, but probably not. He might have to move into yours. But yeah, no, I mean, it's all the insurers are pulling back from all of the coastal states. It's partly climate change. I know we kind of like to point to that immediately, but it's not the biggest thing. The other thing is that property values have gone up. Inflation has pushed the repair costs up. And yes, the frequency and severity of storms is worse. So it's kind of all those things mixed together. I was just at a conference where someone said, a home insurance CEO who I won't name said they just wouldn't even touch New Jersey specifically.
Right. Well, I'm 5 blocks for us. I'm 5 blocks in from the ocean, so I feel, and they're long blocks, they're big blocks, so I feel very safe there. But again, Superstorm Sandy came through, and still to this day, you go down to Manaloking in New Jersey, there are still lots, like a $10 million home got washed away. They haven't rebuilt. It's still sitting there empty. So those folks got crushed. So it's a thing. Matthew Palazola, thanks so much for joining us. Senior analyst covering the insurance business for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker Studio, trying to game out kind of what some of the insurance implications will be from this bridge collapse in Baltimore.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Carnival Cruise Lines reported some numbers. They raised their full-year outlook amid a record-setting booking pace, but they also said that the collapsed Baltimore Bridge might have a $10 million negative impact on their cash flow and earnings for the year. Let's break it down with Jody Lurie. She covers all the consumer stuff for Bloomberg Intelligence. She's a credit analyst over there. So, Jody, what'd you make of the Carnival numbers? It seems like people are cruising like crazy here.
So I would say a few things about that, Paul. First of all, I would say that when you look at Carnival, it's really a cash flow story. It really is a credit story more than anything else, and the bookings are sort of confirming that. Now, the booking level, if you include short and long term, it's actually not at the peak, which was second quarter of last year, but it's right near the peak. And based on what management is saying, it sounds like second quarter of this year might top second quarter of last year. That said, I think more importantly, the company is starting to attack some of its debt load, particularly in some of its secured areas, which will help to sort of free up the balance sheet a little bit, provide some flexibility, make it so that the company has an ability to sort of make its way back to high grade ratings as it's been targeting for 2026.
Yeah, Jody, you called that out. Just using the FA function on the terminal, Carnival Cruise, almost $32 billion in debt compared to a market cap of $21 billion. How does that stack up to the likes of Royal Caribbean or Norwegian and some of those other peers in the cruise liner space?
So yeah, Carnival was able to bring down their debt load to about $30 billion over the past year. And it's likely that it'll probably end this year around that level based on what they're taking in terms of ships. That said, it is significantly higher than Royal, it is significantly higher than Norwegian, but on a leverage perspective, it's sort of middle of the pack at the moment as compared to Royal and Norwegian. Royal is a few quarters ahead of Carnival in terms of its deleveraging strategy. Management at Royal actually bumped up their narrative around getting to investment grade level metrics to do it earlier than 2025. And Carnival stuck to that 2026 number, which I think is descriptive of being a little bit more conservative, particularly with the backdrop of everything happening globally, not just the Baltimore bridge situation, but also at the Red Sea and everywhere else that's affecting Carnival more broadly because of its more global nature.
I'm looking at, again, the FA function is Bailey called out. I still see, $3-4 billion in CapEx every year. Are they buying ships, or what are they spending that kind of money on?
Yeah, the $3-4 billion of CapEx is primarily ship. There is a portion of it that is in terms of maintenance CapEx, right? Your ships get old, you have to update them every few years. You have all these sort of different requirements related to it. They also have that Celebration Key that they're rolling out on, which is on the Grand Bahama. And that's to rival their peers, which have been investing really heavily also into island presence, right? The Caribbean island presence is a moneymaker for all of them. It's this captive audience. They bring the people who are on their ships to these islands and to these sections of islands, like, not the whole Grand Bahama, but that carved out section specifically for Carnival, and wine and dine them, get them to spend extra money. That onboard spend is really where you see that margin.
You mentioned wining and dining. I just want to look at some of the other areas that you cover, talking about Wynn Resorts, MGM, Hilton.
All the fun stuff.
All the fun stuff. Yeah, you have the best job. I hope you take advantage of it. But when you look at the underlying business dynamics of some of the other areas that you cover, what are we seeing in terms of hotel demand and hotel sales and what that means from a credit perspective?
So hotel demands, hotel sales, it is a bit mixed regionally, but I think overall we're pretty optimistic about this year, and that's a function of the fact that business and conference is really picking up this year as compared to the past few years. We're at that point where that post-pandemic narrative has sort of played out, and we're getting to more normalized. That said, there are areas of expansion and growth. We're also seeing that all-inclusive area be a much more attractive area for a lot of these companies. And I think we are seeing some rivalry across the board when it comes to hotels, casinos, cruise lines as these destination opportunities. We're talking Las Vegas, obviously not the regional casinos, that's a little bit different. But Las Vegas, Macau, the cruise lines and the hotels, there's a lot of sort of this destination narrative that's going on to get people to spend that extra money and to sort of go on vacation, live life to the fullest. Now, we do have these partnerships that are happening between Marriott and MGM, but then also we have an MGM and Carnival relationship. So there is this fluidity that's happening within my industry that makes it sort of interesting.
And you get a great view on the consumer, Jody, with the coverage you have. Again, hotels and casinos and cruise lines. Where are people kind of spending their dollar? And it seems like they're still spending on that whole experiential thing, the experiences. What are the companies you cover? What are they saying as to how that's likely to play out?
So consumers are definitely spending still on experiences. We're still very much seeing it. Now, if you compare 2023 to 2022, It's a different sort of narrative than 2023 to 2024 because the base is much greater, right? If you looked at the base going back to 2021, you're dealing with nothing. Building on nothing, it's very significant. That said, there still is that narrative of growth and that consumer spending on experiences. Where we sort of wonder is what's going to happen heading into the second half. That's sort of the puzzle piece that isn't quite filled out for us yet, where first half into the summer season is very strong. We're also seeing that for cruise lines. They're saying that going into 2025, they're seeing strength. And that's a function of the fact that people book their cruises so far in advance. You don't get that benefit in the hotel space. You don't get that benefit as much in the vacation arena elsewhere. People don't book vacations apart from cruises so far in advance. So I think as we head into second half, we'll sort of get a feel for how comfortable the consumer is in terms of spending.
And Jody, I just want to ask about the Fed. If we do have higher for longer, and if a rate cut keeps dragging on, how does that impact the kind of areas of your coverage differently, whether that's sector by sector or company by company?
It's a combination of factors. So when you're talking the cruise lines, a lot of the narrative is around repaying and refinancing debt. That refinancing portion won't be as attractive if we're higher for longer. The other component, though, is on the consumer side. So you have the high-end consumers that might benefit or not from high interest rates or, a elevated stock market price of sorts. But then you have the lower end consumer that might feel a little bit more of the pressure. I think the more important piece is that inflation factor, where you say, okay, from the inflation standpoint, how much is the consumer feeling it? How are they feeling it directly in their wallet? And how much are they willing to borrow in order to continue that spending? And so I don't really know how that's going to play out. That's, there are other people within the firm that are really very smart and can talk more to that. That said, that is something we are monitoring from the standpoint of how much the consumer is stretching, because that narrative around consumers having extra cash on the sidelines to pump into vacations isn't so much there, but the thought process around spending on vacations and that mentality around spending on vacations still exists.
All right, Jody, thanks so much for joining us. Really appreciate it. Jody Lurie, she covers all the consumer companies, all the fun companies. She does it from the credit perspective. Talking about Carnival Cruise, reported some numbers today, took their guidance up a little bit, citing, even though some concerns, a little bit near-term, short-term, small hit from Baltimore. Have you cruised before?
I'm not a cruise person.
So you're not cruising for the honeymoon?
Honeymoon, no. We are flying to Portugal and then flying and driving, renting a car.
Lise Mateo cruiser?
No, I haven't. I'm kind of scared. I don't know. Titanic comes to my head, and I'm like, I can't do it.
My thing is I don't like people, so that's kind of
that could be a problem.
That's a problem for me. So be stuck on board with 3,000 people onto this ship.
Lisa says Titanic. I use the pandemic as exhibit number 600 for me to not do it, and you're just I don't really want to interact with others.
I just don't like people. Yeah, so I don't need to see it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Speaking of a global investment bank, let's get to Alison Williams. She covers the global investment banks for Bloomberg Intelligence. She joins us from Princeton, New Jersey via Zoom. Alison, I guess the most recent story out is UBS. They're selling an $8 billion in loans to Apollo. I guess these are some loans they picked up when they acquired Credit Suisse. What's going on with our friends in Switzerland?
Yeah, so this is really just wrapping up a deal that Credit Suisse had put in place some time ago. So even before UBS had purchased Credit Suisse, they were winding down the investment banks. They had this business, the securitized products group, that they were getting rid of. And so they, upon consummation of the deal, some of those assets had been sold off, but the rest had been put in sort of a non-core unit. So I think this is really just kind of closing the loop on that. And it just shows progress that they're continuing to wind down the business. Some of the more, I don't want to say unprofitable, but sort of some of the more volatile assets, balance sheet intensive, the types of things that UBS really does not want to be involved with.
And Alison, UBS booking a net gain of $300 million in the first quarter related to the deal or the matter. Is this just a big win for them, given kind of how they're shedding the assets?
Yeah, I mean, I think if you look at some of the numbers that they gave, I mean, and there's obviously sort of the ways that they accounted for the transactions when they did the deal. I think, the important thing is probably not the direct impact, but just shedding those assets so that they can, kind of return to the core business. They have a huge road ahead. I mean, this is, $8 billion in assets. It's about 10% of the non-core book that they want to get rid of. And they're sort of on a long path of integrating the two banks. They've got big restructuring charges ahead. I think what we're focusing on really in the first quarter is, can we start to see some results from this investment bank? That part of what they wanted. Obviously the wealth assets are huge for them. The Swiss assets are huge for them. But another thing they wanted was the investment bankers. And Credit Suisse really did have expertise in the tech area. As you know, Paul, they have a great reputation and done really well on tech IPOs. And what we've seen in the first couple of months of the quarter is UBS really moving up the league tables for tech IPOs, showing that they might be getting some of that benefit.
I'm looking at the stock here of UBS. Thank you. I'm looking at the stock here, Alison, of UBS. The stock's kind of flat year to date, but it's up 65% on a trailing 12-month basis. So when you talk to institutional investors out there, what's the call here on UBS?
I think, it depends probably a little bit on your time frame. It's going to be a long slog. And so I think, the broader look at the company, and as you know, we don't make recommendations on stocks, but I think, when I talk about this company from a fundamental standpoint and how investors might be looking at it, it's going to be a very long time for them to, sort of get this deal done, the execution. As I said, we're looking at mid-single-digit returns in the year ahead. So there's sort of a long path to go to the 15% return on common equity that that they're kind of targeting in the long run, and a lot of work to do. So it depends on sort of the investors' patience. Also, somewhat of a show-me story. I think that the big gains last year really reflect that they did this deal. It was a very financially attractive, just given the structure of the deal, and especially what happened with the AT1s, and the fact that they were able to stabilize the wealth flows and stabilize that franchise. So I think a lot of the initial concerns were, will they be able to preserve some of that value, or will their competitors pick it off? And I think they did show that they've stabilized it. So we have the foundation, and now just need to start doing some of the heavy lifting.
And Alison, Paul's looking to put some money to work. He's got his eye on global banks and asset managers, which is exactly what you cover. What stocks do you like right now, and where does UBS fit into it?
Okay, well, as I said, we don't recommend stocks, but I will talk about, the fundamentals. And I would say that, one of the big things that investors are looking for this year is a pickup in fees. We think that we will get good growth in fees, but, we're nowhere near the 2020 levels. So that story could end up being a little bit disappointing. But trading, on the other hand, holding up really well. The asset values are great for asset managers, right? Especially from a mix perspective. We have equities at record highs. That definitely helps the fee prospects, because more assets just mathematically turn into more fees, and the potential for more flows. The flows are always tricky. They've also been good for the hedge funds and asset managers doing well. That means Goldman's doing well in their prime brokerage business. They do have more of a bent to those types of customers, but we think trading looks good across the banks. Bank of America is also someone that we're watching gaining share. Bank of America and Wells Fargo, who's a smaller one, but the share gains are really more meaningful for them because they're smaller. So from a fundamental standpoint, those skewed to trading, like Goldman Sachs, looking like a strong quarter.
All right, Alison, thank you so much for joining us. Alison Williams, Senior Analyst. She covers all the big banks, investment banks globally for Bloomberg Intelligence. She's based down in Princeton, joining us via Zoom. I guess one of my questions is, again, having worked for one of the firms that now makes up UBS, that being Payne Weber, I still don't know what UBS's kind of global ambitions are. Do they intend to compete against the JP Morgans, the Morgan Stanleys of the world, or are they, they're a little bit more focused maybe on just a handful of markets, a handful of business lines, and not going to kind of compete across the board? I'm not really sure. Now that they've acquired Credit Suisse, kind of what's happening there. But I think typically the street rewards, at least for those investment banks, kind of just focus.
Yeah.
Like Morgan Stanley focusing on the wealth management business, which has been so good for them.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the most read stories on the Bloomberg terminal is regarding former President Donald Trump. He is richer than ever, yet still strapped for cash. The former president's fortune on paper has vaulted to $7.2 billion thanks to his newly public media company. And the ticker there's DJT for his initials. But legal strains threaten his finances. To get more on that, we welcome Erik Larson. He covers all of this stuff for Bloomberg News. He joins us here in our Bloomberg Interactive Broker studio. So, Erik, I'm looking at DJT. Stock's up another 11%. It's had a heck of a run here. Up 270% year to date, 370% over the past year. A heck of a good run for the former president. So there's net worth. How about cash? Talk to us about those two dynamics.
Right. So it was actually Bailey's story I was reading earlier about DJT. It's very fascinating. He's obviously more than doubled his wealth. But Trump testified in a deposition last year in one of his civil lawsuits that he had more than $400 million in cash. Just last week, he said on Truth Social that he had almost $500 million in cash. We're not exactly sure. We can't really exactly verify that. But he had been saying in that court case that he was low on cash. He didn't have enough to post this big bond. So that's kind of our relationship with Trump's cash right now, is his comments in regards to that huge bond that he has to pay for his appeal in that case.
And so your story calls out $7.2 billion in wealth on paper. How much of that is in Trump media? How much of that is real estate and other ventures?
Right. So it seems like the bulk of it is actually on paper, as you mentioned, from the Trump media. His real estate has always usually been the bulk of his wealth, about like 2.7 billion or so. I don't have the story right in front of me, but clearly that's what Bloomberg Billionaires Index put his wealth at 3.1 billion before these verdicts. So the vast majority of that was real estate. And of course, there's licensing deals around the world and things like that. So now that with Trump media, his wealth is largely from this shares, which is fascinating to me. But of course, his real estate continues to be, his crown jewels of his portfolio.
Yeah, so I'm looking at DJT, Trump Media. It's got a $8.7 billion market cap. And I pull up FA, the financial analysis section, to see the financials for this company. And I don't really have any. What's going on?
Well, part of that is because it's a SPAC deal. Our filings kind of are backloaded. That's why I will caution with SPACs.
So what do we know about the financials of this company?
Revenue $3.4 million in the first 9 months of last year, and they lost, I think, Eric, correct me if I'm wrong, about $30 million.
Right.
So we're valuing that company at $8.8 billion.
Correct.
Just so I can get I'm an equity analyst. I'm trying to do my valuation here.
Paul, it's a 2000. Last night it was a 2,200 price to sales multiple.
Price to sales.
Reference NVIDIA is about 38.
Okay.
So.
Understood.
And
Okay.
what was Facebook? I believe I saw when it went public was something maybe like 12 times its revenue.
So this is are we characterizing this company at this stage as a kind of a meme stock?
I mean, we could call it a startup.
Okay.
But it certainly has been put in that category. I think when one meme stock moves one way, a lot of them tend to. I think that's sort of been true with this.
Okay. So what do we know about the liquidity of the former President Trump? Again, he's been given a little bit of a reprieve here to come up with this $175 million bond. But again, there still is that judgment out there for the larger amount.
Right.
But I guess the expectation is he'll satisfy that bond either with cash or...
He has said that he will satisfy that with cash. Keep in mind that earlier, or just in January, he lost a big defamation trial with writer E. Jean Carroll, who had accused him of sexually assaulting her in the 90s and then defaming her by denying it. And that was an $83.3 million verdict. He did post a bond in that case of over $91 million in order to put it on hold while he appeals. So that took up almost $100 million right there. Then we're getting 175 from this next upcoming bond. And he has said he still also wants to be able to spend some of his money on his campaign. So that, I mean, even based on what he's saying he has, that's using up a lot of it.
And Erik, when we look at the inability, from my understanding, to borrow against his Trump media stake, can he take out loans against some of his other real estate? Like how, if he doesn't want to use the cash on hand, how can he kind of churn up some money?
I mean, that certainly is an option. I think some wonder if he hasn't already done that, though, with some of his properties. We know that he's refinanced some of them, but he has claimed that he has very low debt on his properties. So certainly one of them he should be able to borrow against if he really had to. But it's also possible that he could get the board of TMGT to change the rules on that lockup period potentially, and which would allow him to sell some shares theoretically before that 6-month period, although that might be a bad look with some of the other buyers.
Interesting. I mean, looking at the MGMT function, the management function for the Trump Media and Technology Group, again, the ticker's DJT. I don't see former President Trump on the board or listed as an executive, but I do see his son is on the board, Donald Trump Jr. But do we know of anything of his interaction with this company, or is he simply the shareholder?
Well, he's certainly the face of it. Yep. I don't know exactly how much in the day-to-day he's involved in it, other than, of course, being the star user of its main or only product, Truth Social. So, you know, as you pointed out in your story, Bailey, a lot of these purchases, this stock is largely seen as a bet on his political futures as well. So, in a way, these meme stocks are betting against. They're betting against Wall Street, or in this case, betting against people who are Trump detractors who don't think he can win. Okay, well, certainly having a good run here. That's for sure. There's certainly some buyers out there. We're seeing good volume again. The stock up over double digits here, about 12% on some pretty decent volume. Erik Larson, thanks so much for joining us. Erik is a Bloomberg Legal Reporter on this story. That it's a great headline. Trump is richer than ever, yet still strapped for cash. So we'll see how that plays out going forward. And the question I have, Bailey, is just as a someone who used to follow the social media companies like Facebook, like Snapchat, wonder have to take a look and see kind of where the users are, where the revenue is, and see kind of what the opportunities are for this company.
And that's been the big thing when I talk to investors who are not in the stock but are on the street, and their big question is, how can you actually monetize a business? If he wins the presidency, does that then draw people to Truth Social and advertisers in turn, or do they go out and acquire companies? That's the big kind of question, is how do you fundamentally value what really is a app that has been around for a little over a year at this point?
Right. And, just seeing the business model for these social media companies, it's very simple. It's no different than the magazine business back in the day, the newspaper business back in the day, is you amass an audience. The bigger the audience and the more engaged the audience, the more valuable that is to advertisers. You amass an audience and you sell advertising against that audience. As simple as that. Maybe a little bit of e-commerce in there if you're fortunate, but really it's an advertising game. So the question for the folks at Trump Media and Technology Group will be what kind of audience they can amass over time.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.